Good evening, guys. My name is Larry B, and I'll be taking you on a course on technical analysis. And the topic for today is candlestick patterns. Candlestick patterns. As you can see, in every chart that you see, whether stocks, whether forex, whether crypto, you'd always see something like this. We call them candlesticks and candlestick patterns. They are everywhere on everybody's charts. They are all everywhere. You find it on any chart, different candlestick patterns. Now, what are candlesticks? Candlesticks initially originated from Japan hundreds of years ago. Originated from Japan, then it was later modified. Candlesticks rather, they represent price movements over a selected time frame. For example, if a trader is looking at a 15 minutes time frame chart, each single candlestick represents a price movement over 15 minutes. For example, now look at this place. This is my time frame for whatever I'm analyzing. If I go to the 1 hour chart, that means for every candle that I'm seeing here, it represents 1 hour. As you can see, 20, look at the date, 30th July 21, 2000, 2100, 2200, as you can see. So every candlestick represents 1 hour because I'm looking at the 1 hour time frame. If I go to the 4 hours chart too, every candle here will represent every 4 hours. See 0, 0, 0, 4, 8, 12, as you can see, it represents 4 hours. If I go to the daily chart now, for every candlestick I see, it is a daily chart, as you can see, 1 day. See 26 April, 27 April, 28 April, 29 April, 30 April, as you can see. So that is basically how it works. Just a minute. So that is that for that. And the candlestick is formed via the following. As you can see, we have opening price. This is the opening price here. This is the closing price. We have bullish and bearish. This is the opening price for the bearish, and this is the closing price for the bearish. Opening price, this is where the candlestick starts from, or where the movement starts from. Then the eye represents the highest price that the candlestick reached. As you can see, this is the highest price the candlestick reached. Then we have the low. The low represents the lowest price that the candlestick reached. As you can see, low. This is the low. This is the lowest price. Then we also have the close. This is where the price closed at. The price closed there. The price closed there. So let me show you people at the chart. So let's take this chart for example now. Sorry. Let me go back to the 4 hours time frame. So for example now, take a look at this now. Look at this candlestick. Let me zoom in very well. So look at this. This is a bullish candlestick now. But look at that means, for example, let's take this bearish, for example. That means the bearish opened here. It opened here and closed here. But this was the low and this was the high. Then it closed here. When the candle closed here, it opened when the next candle started, another 4 hours. So you get, remember, a candlestick represents a particular time frame that you are looking at on that chart. So I'm looking at let me use 1 hour. It should be easier to explain it to the 1 hour. So let's say this is where it started from now. So this is the bearish now. It came down to this place. It started here, but it came down as much as this, went back towards this place. Then it later came back and closed here. Then this one started here, came down a little bit, then went back towards this high, then came back and closed there. So look at this, started here, went as high as 38,994, then came back and closed at 38,863. So that's just the basic about this candlestick. This is the open for a bullish. This is the open for a bullish candle, and this is the close for a bullish candle. Then the high and the low. Then for a bearish, this is the open. This is the close, this is the low, and this is the high. It is very, very straightforward. And there are basically two major types of candlestick. We have the bullish candle and the bearish candle. So the bearish candle, let's talk about the bullish first. This is a bullish candle. A bullish candle is formed when prices closes above the open. And the color of a bullish candle is usually white or green. You see it in different charts. Some people use white and black. White and black or green and red. Some people use white and black or green and red to represent their candlestick. So white or green represents bullish. That means the candle is going up. The price of the coin is going up. Then the bearish candle is either black or red. That means the price of the coin is going down. That means it is going down. So this is just the way it works. So for example, now look at this. This is a bearish candle. See, prices went as high as 38.2, but later came back and closed at 37.8. As you can see, then for this bullish now, it opened here at 38.154 and later came as high as 38.936, but later closed at 38.849, as you can see. So it's just like this. This is how you check the open, the close, the high, and the low of every candlestick. And this is just how it is. The last one, whenever you check your chart, the last one is still ongoing. You will see the time here. It is ongoing. So it means it still has 52 minutes left for it to close. See, it is a 1 hour time frame chart. So it means it has 52 minutes left to close. If I go to the 4 hours now, that means it has 1 hour, 52 minutes left for it to close. So if it is like this, you wait for it to close, for you to know what is happening in the market. You don't just jump into the market and place a trade like this. You wait for the candle to close. Because it might later come down here before it's closed, or it can go as high as this before it's closed. So you understand? So it is not certain when it is moving like this. This is where you should check. This is the current price, current market price, and the time. This is how you see it. The candle basically represents price movement across a period of time. So this is the time, and this is the current price. This is the time frame that is remaining. If I go to the daily time frame, it will be different. So it remains 5 hours, 51 minutes for this candle to close, for this bullish candle to close. This is a bullish engulfing pattern. It might signal another uptrend. Looks most likely based on this daily time frame, because we've been on a downtrend for 48 days, and this is a bullish time frame. It might close as high as 40, 41K eventually. Because once you see this, then another candle will most likely follow. If it closes like this, another bullish candle is most likely to follow, as you can see. Whenever you see a very long candlestick, see bullish engulfing, the next one is usually green, like most of the time. The next one is usually green. It's usually green before any change in the market. I'm sorry, just a minute. So candlesticks are very important to trading analysis because it is a visual representation of what is happening in the market at a particular period in time. So understanding candlestick patterns will make you understand what most market participants are doing in the market, most especially what people with big money are doing in the market. The market moves according to imbalance between buyers and sellers. Like I said yesterday, it's basically the principle of demand and supply. That is just the thing that works in this market, principle of demand and supply. The buyers and sellers, what are they doing in the market? That is what these candles show us. That is what all these candles, that is what they show us. They only show us what the buyers and sellers are doing in the market at a particular period in time. So the market moves according to what you are seeing on the chart. So if there are more buyers than sellers in the market, then you're expecting the price of the coin to go up. See, it was going on a downtrend there, but then the buyers stepped in, and immediately a lot of buyers stepped in. The price of the coin kept going up from 29.8, and it went as high as 42,300 before coming down a little bit, as you can see. So that is just the way this market, that is just the way it works. You go with the trend, what is happening at that moment. So once you see that sellers stepped into the market again from here and it went down, now buyers are entering the market again. So it is most likely to go up a little bit, probably before a reversal or anything can happen. And if there are more sellers than buyers in the market, you're expecting the price of the coin to go down. It's very simple and straightforward. So understanding candlestick pattern will guide you on when to enter and exit the market and when to stay far away from the market. Because there are some times, especially when the market is consolidating, like I said yesterday, uptrend, downtrend, and sideways or consolidation. When the market is consolidating, you are not really expected to trade that much because the market is just ranging across a particular price range. It is not specific whether it is going up or down. It's just moving within one direction. So during those periods, you are literally expected to stay away from the market. So the market now has a direction of its own. So you tend to understand if it is an uptrend or a downtrend by looking at the market. So as you can see, look at it, uptrend. This is clearly an uptrend. This was clearly a downtrend. See, this was clearly a downtrend, and this was clearly an uptrend. So that is how to identify that. Now, candle can be divided into two parts. You have the real body, then we have the wicks and the shadow. Like I said earlier, the real body. This is the real body. The full body here is the real body. This full body. Then this is the wick or shadow. We call it wick or shadow. Wick or shadow. It's basically the price that it went to, then it was rejected, then it came back up, or it went here and was rejected and came back down. So you just relate it based on the candle that you are looking at, whether it is bearish or bullish. Now, the real body is the part of the candlestick that is completely filled, while the shadow or the weak part is referred to those thin line. Those thin line at the end of the candlestick, it will be at the top or at the bottom, as you can see. It's at the top, it's also at the bottom. It's at the top, it's also at the bottom. But here, it is at the bottom, but it's not really showing at the top. It's not really clear at the top. So it does not matter. Sometimes it can be up, it can be down. Sometimes it might not be up, it might be down. So it just varies. It varies from each other. And candles come in different sizes. You have the long and short candles, as you can see. These are long candles, short candle, long, short, long, long, long candle. Long signifies a very strong move. Like the move is massive. Then short signifies a little bit. It basically signifies a little bit, as you can see. It basically shows little buying pressure if it is bullish, a little buying pressure. But if it is bearish, little selling pressure. And if it is very big, that means that means the buying pressure is very, very high. That means the buying pressure is very high at that moment. That means it's very high at that moment. Now, candlestick patterns are patterns created by candlestick movements, which enlightens us and gives us an idea of the possible direction of the market. Like I said earlier, you don't predict, you react. So you look at it at what is the market doing at a particular period in time. And once you understand what the market is doing at that particular period of time, that is when you'll be able to know when to enter the market or when to exit. So you need to understand what the market is doing, then you enter or you exit the market. Candlesticks are like the language of the market. So understanding this language will give you information about the market dynamics, traders' behavior, and potentially give you an edge in knowing where, when, and how to enter and exit the market. That is what I just explained earlier. It basically gives you an idea of when to enter or exit the market. There's no two ways about it. Once you understand what the market is doing, imagine if you see something like this, and you know that buyers have already stepped into the market, you follow the trend. You don't predict, you follow the trend. As at this place where the market was going down, people follow the trend, so you follow it. Then once the trend changes again, you follow again. That's how to be profitable. You don't just enter the market anyhow and predict rubbish. Now, to the types of there are basically eight major candlestick patterns that you should understand. Some are bullish, some are their bearish patterns. For example, now we have the engulfing bar pattern, and the engulfing bar pattern has the bullish and the bearish one. We have the doji candlestick pattern. The doji has the bullish and the bearish too. Doji is like an indecision. It's basically an indecision candlestick, so it still has its own bullish and bearish. We have the gravestone doji and we have the dragonfly doji. Then we have the morning star pattern and we have the evening star pattern, bullish and bearish. We have the hammer or pin bar pattern. The hammer is a bullish candlestick. Then we have the shooting star. The shooting star is bearish. It is the opposite of hammer. Then we have the Arami inside bar pattern. The Arami also has its bullish and bearish pattern. Then we have the tweezers top and the tweezers bottom pattern. So in the next video, I'll be going fully and elaborating on these different candlestick patterns. Yes, good evening, guys. My name is Larry B, and this is a technical analysis course. And the topic we are taking today is still candlestick patterns. And like I said earlier, I said I'll be showing you the different candlestick patterns that you need to know and be able to identify in your chart. So, and the first one is the engulfing bar pattern. As I am explaining, I'll be showing you on the chart also. The engulfing bar pattern. The engulfing bar pattern. An engulfing bar is formed when a candle fully covers or engulfs the previous candle. It has to engulf at least one previous candle for it to be considered an engulfing candle. It consists of at least two candles. For example, the smaller candle and the longer candle, which engulfs that smaller candle. And there are two types of engulfing bar pattern. We have the bearish engulfing bar pattern and we have the bullish engulfing bar pattern. So this is the bullish engulfing bar pattern. This is the bullish one. Then if you go back here, we have the bearish one. Where is it? Where is it? Yes. This is how the bearish looks like. You have a smaller green candle, then a longer one that covers the green one. It's basically the body. The wick doesn't matter. It is the body that matters when you're looking at engulfing bar pattern. Look at it again. It is the body. The body must engulf the smaller one. So as you can see, bullish means that it is the green candle that is engulfing the red candle. While for bearish, it means it is the red that is engulfing the green candle. So let's look at it in our chart now. Bullish engulfing pattern are always constant in our chart. They're always there. They're always there. See. So look at this. This is the bullish engulf. As you can see, the greener candle totally engulfed this bearish candle. See the bullish one. And this is the bearish engulfing bar. See how it totally engulfed the bearish and the green candle, as you can see. So it is opposite. They are opposite of each other. They are opposite of each other. You can find it everywhere. You see an engulfing pattern in almost every chart. They are always there. If I go to the 4 hours time frame, it's clearer. See, this is a bullish engulfing pattern. This is a bearish one again. This is a bearish one. See, it covers it. See another one. See another bearish one. As you can see, immediately it happened. It covered it and went down. See another one. Be careful. Always make sure that you are looking at it at important zones. At important zones. See, this is a very important zone. It is at a resistance. See, price went down as low as this. As low as 32,750 from 36,000. See another bearish engulfing. Went from 34 to as low as 32 again. As you can see. See the bullish engulfing candle. See from 32. See how it engulfed this smaller candle. And it went as high. It went as high as 39.7 from 32K, 33K rather. See how it moved. Sorry, it went from here rather from 31K. It moved up to 39K. As you can see. So that's how it is. That's for the bullish and bearish engulfing pattern. So let me basically explain the bullish candle. The bullish engulfing bar pattern, it tells us that sellers are losing control in the market and buyers are stepping in and looking to drive the prices to the upside. So whenever you see a very strong bullish engulfing pattern at a zone, you should understand that the trend is about to change. That is why it is usually after a bearish candle that you see it. You see it after a bearish candle. You always see it after a bearish candle, as you can see. It means buyers entered the market, they tried to push it forward, but they failed here. And it came back again. As you can see, sellers tried it. It went down, but still came back and So you get. So when this pattern occurs at the bottom of a downtrend, take note of this. It must be, if you are looking for a strong bullish engulfing pattern, make sure you are looking for it at a zone, at major zones. Make sure you are looking, look at it here. Make sure you are looking for it at major zones. See how the price moved to an uptrend. So make sure you are looking for it at zones. That is the best way to enjoy the candlesticks pattern. Make sure it is at important zone. See, it came up, went as high as this, then it came down again. Then it came back here and went as high as this. So you get. So that's just the basic about that. So if you notice a bullish engulfing pattern in an uptrend, it is a sign or signal that the market will continue higher. So let's say you're already in an uptrend, I keep seeing a very strong bullish candlestick. See, for example, look at this place now. The trend started there, but see, it was bullish. It shows that buyers entered the market and the pressure is very, very high. So it kept going up. It kept going up. It will keep going up like that. So it gives you a potential opportunity to enter and join the trend at that level. So when you are monitoring the market here, and you notice this first one, that it is bullish, then you see a strong bullish, you are supposed to enter the market around this area. If you are a day trader or a scalper, this is where you are supposed to enter the market. You waited for this to close, then you enter the market here, then you follow the trend. You are not predicting, you are reacting to the market. Then look at this place. The buyers tried to push the price upward to this place, but the sellers came in again, they pushed it back. They tried to push it back again. Then you see a strong one. So it's closed there. As a trader, as a scalper or day trader, you enter at the close, then you follow the trend, you take your profits. When you see another change in trend, you take your profit and you leave the market. Simple and short. That is just how that part works. So the market psychology behind this bearish engulfing pattern is the fact that buyers are trying to push the price upward, but the bearish pressure stepped into the market and drove the prices as lower as possible, leading to the bearish engulfing bar. So you understand? So whenever you see something like this, sellers are trying to push the market to the downside. And when you see a bullish trend like this, it means buyers enter the market and they are pushing it back upward. As you can see, we are currently on an uptrend again from a downtrend. So when this pattern is spotted at the top of an uptrend, it signifies a potential reversal. So for example, now, let's say the price kept going up. See, look at an uptrend. The price kept going up. And once you see something like this, a signal that the trend is reversing. That means there's about to be a change. There's about to be a change in trend. Then the market comes down. That is a change in trend. So that is what basically the bullish engulfing and the bearish engulfing pattern entails. So the next one is the Doji candlestick pattern. Let me show you how a Doji candlestick pattern looks like. This is a Doji. It's basically very tiny. It's usually very tiny. You don't see it often in your charts, but it's always there. This pattern represents indecision in the market. This candlestick is formed as a sort of balance of power between the buyers and sellers, between the bulls and the bears. It basically means that as the buyers are trying to push it up, the sellers are also trying to push it downwards, keeping it at a balance, an equilibrium. So that means the opening price and the closing price was very close. So it means the opening price and the closing price was very close. So a doji is formed when the market opens and closes almost at the same price. It signals that nobody is in charge of the market at that particular point in time. That means there's indecision in the market. The buyers and sellers are fighting over who will control the market. So nobody knows where the market is going. This is an example of a doji. It will signify a reversal or a continuation. See, as you can see, it's usually very tiny. So let's say as you can see, the closing price was 39,781. Then it closed at 39,769. So it was very, very, very close. Very, very close. So they pushed it as high as 39.9. Then it went down as low as 39,683. But they still came back and closed very close to the opening price. That is what they do. It's basically an indecision in the market. So when this pattern is spotted in a trend, whether it is an uptrend or downtrend, it will signify a potential change in trend. So it means that nobody is controlling the market at that moment. If you see it, then you see indecision. As you can see, it was already, if you look at this one, it was already on the downtrend here. Then the doji showed that nobody was in charge of it. That means the sellers were losing control of the market. Then buyers stepped in eventually a little bit. Then another doji again, indecision. They could not control the market. Then sellers pushed it downwards as low as this. So you get. So that is basically what it entails. So if a doji is found at the top of the market or bottom, it's basically telling you that the trend is about to change or the trend is most likely to change. And we have two basic types of doji patterns. We have the dragonfly and the gravestone doji. Let me show you the dragonfly and the gravestone doji. This is the dragonfly. Dragonfly is bullish. That means the sellers pushed the price towards this place. They pushed it down here. Then the buyers pushed it back and it closed almost at the open price. Closed very close to the open price. Sellers pushed it down, but the buyers pushed it back up. It's when it later closed almost at the opening price. Then if you look at the dragonfly, the bearish doji pattern, It means that the market opened here, right? Then it kept going up, going up, going up. The buyers entered the market. Then eventually sellers stepped in again within that time frame and they pushed it back towards the opening price. That is basically the simple explanation. So this is an explanation. Look at this now. See, it went down. It went down as low as 46.61. Then the buyers pushed it back almost at the opening price. See, it opened at 41.284. It closed at 41.247. So it was very close to the open price. Let me look for the gravestone. I saw the gravestone somewhere. Sorry. Yeah, this is the gravestone Doji. It's the opposite of the dragonfly. As you can see the open price based on this. They pushed it high. They pushed it high up to 38.5, but sellers pushed it back. Then it closed slightly below the opening price at 38.66. So that is just it. So it could signify a continuation or a reversal. It just depends on where the trend is going. It just basically shows the power of the buyer and seller in the market. See, as you can see, it was in an uptrend. It was spotted in an uptrend. Then subsequently, the trend changed a little bit, came back, then came back towards the downside. So like I said, dragonfly candlestick pattern is a bullish doji candlestick. This formed when prices open and close at almost the same price, but slightly higher than the opening price. So when the opening and closing price are almost at the same or very close, it is a doji pattern. So this candle is characterized by the fact that it has a very long lower tail and a very small body. The body is very, very small, as you can see. The body is very small, but the tail is very long. Dojis are almost everywhere. See it here again. It's everywhere on the chart. Then the psychology behind the dragonfly doji pattern is the fact that sellers were trying to push the price lower, but bullish pressure stepped into the market and drove the price back towards the opening price or a little bit above the opening price. So when this pattern is spotted at the bottom of a downtrend, if you see a dragonfly doji at the bottom of a downtrend, it basically means that the trend is about to change. And if you see a gravestone at the top, it means the trend is about to change. As you can see, it later happened. It dropped. It's just an indicator that the trader should be careful that prices are most likely to come back downwards. Because gravestone is the bearish version of the dragonfly. So it's also formed when the opening and closing price are similar. They close at almost the same price, but slightly lower than the opening price. And the major difference is that it has its tail at the top rather than the bottom. So for dragonfly, the tail is at the top. Let me show you the picture. See, dragonfly, the tail is at the bottom. But for gravestone, the tail is at the top. As you can see, it's very, it does not have to be exactly like this. It might have some little drop here, a little wick along this place. It might have little wicks, but it does not mean anything at all. It doesn't have to be exactly like this for it to be a gravestone doji. As you can see the chart, it doesn't have to be exactly how it is in the pattern. It can have another wick at the bottom, but the most important thing is that long wick at the top, as you can see. So that is that for doji. Then the next one is the morning star pattern. The morning star pattern. Where is the morning star pattern? So this is the morning star pattern. This pattern is a bullish reversal signal and is most often seen at the bottom of a downtrend. Like I said, uptrend, downtrend, sideways. Downtrend is when the price is at the bottom, while uptrend is when it is at the top. So this pattern consists of 3 candlesticks. The first candle is the bearish candlestick, which shows or tells us that selling pressure is still in the market. See, you see it here. You see a red candlestick, a strong one. And the second candle is a smaller candle. It could be a doji, it could be dragonfly, it could be gravestone. You see it in the middle. You see it in the middle, telling you that the sellers are losing their momentum, that buyers are stepping into the market already. Then the third one, which is like a confirmation, which completes the pattern, is a very strong bullish candle to the upside, telling us that buyers are now taking over from the bears in the market and are looking to push the prices towards the higher side. So this pattern shows how buyers are taking control of the market from the sellers. It is a very, very strong reversal pattern. If you see it at the downtrend, it is a very, very strong reversal pattern. Very, very strong one. So, and the second candle is not a must for this middle candle to be exactly like this. It can be middle, it can be here. It can be in the middle here. It can be as high as this. It can be as high as this, but it is usually very small. It's usually small. It usually has wicks rather. It usually has wicks. It doesn't have to necessarily be like this, but this this red candle and the green candle are usually there with a smaller candle in between. With a smaller candle in between. So the third will always be bullish to the upside. So you get. So let me show you in the chart. Let me show you the morning star pattern in the chart. Sorry, this is the morning star pattern. See, as you can see, it doesn't have to be exactly the way it is on the other side. See, a bearish one, a doji, then a bullish candle. As you can see what happened. Immediately the reversal happened. It went up. As you can see, it went up. Immediately this happened. So it is a bullish pattern. It tells you that the prices are going to the upside. Most of the time, it always pushes the price to the upside. As you can see and see, bearish, indecision, bullish, followed by another bullish, followed by another bullish, like that, like that. Then the next one is the evening star pattern. The evening star pattern. What's the evening star? The evening star pattern is the opposite of the morning star pattern. Like I said, the morning star is bullish, the evening star is bearish. So it's just like opposite of the other one. So yeah, you see a green candlestick, then indecision, then bearish one, telling you that the sellers are entering the market, telling you that price is most likely to continue to the downside. Then prices will start dropping. So it involves 3 candlesticks, just like the morning star pattern. So the first candle is bullish, showing that bulls are still in the market. The second is very small, showing that there is indecision in the market and prices are most likely to change to the downside. Then the third candle is a strong bearish candle. It's usually strong, like you see it clearly in the chart. So when this pattern is spotted at market top, it is a very strong indication that the market is likely to reverse in the opposite direction to the downside. So let me show you the evening star pattern on the chart. Evening star, where is it? I spotted the time. This is the evening star. See it here. You see a bullish and a bearish one. As you can see, indecision and a bearish candlestick. So like I said earlier, you don't trade candlestick pattern alone because nobody's father owns the market. See, as you can see, it happened here, but the buyers came back into the market and took control. It didn't go to the downside. It didn't go to the downside. Buyers came back and took control of the market. Buyers came back and took control of the market. And that is that, as you can see, this is the evening star pattern. Bullish, indecision, bearish. Then the next one is the hammer or pin bar pattern. The hammer pin bar pattern. As you can see, the hammer pin bar pattern is bullish. The hammer candlestick is formed when the open, the eye and the close is very close and the distance between them is not much. This happens when the distance between the price is not much or very close. So a market opens and creates a high and closes very close to the opening price. This pattern consists of a smaller upper body and a very long lower shadow or tail. We call it wick, W-I-C-K, wick. So the psychology behind this pattern is that sellers were pushing the price downwards. So like I said, it opened here. So let's say the market opened here, then sellers pushed it downwards. Then buyers pushed it back up, then pushed it above the opening price. But it is more visible, unlike the doji. That is the difference. It is more visible. It's like an hammer. The edge, the body is still a little bit thick compared to the doji that has very tiny body. So the psychology behind the pattern is that sellers were pushing the price down. Then it got to a point where they could not push it further downwards. Then bullish pressure steps into the market and drove the prices high and make sure it's closed above the opening price. And this hammer pattern is a very, very strong reversal candlestick when it is spotted at the bottom of the downtrend. And it will give us a potential buying opportunity when traded correctly. Let me show you in the chart. Hammer is everywhere. You always find it seen. This is an hammer. You also find it here. See, it is bullish. See the strong bearish candle. See the strong. They tried to push it. It opened here. They tried to push it down, but buyers stepped in and pushed it back upward. Then look at what happened. Price kept going up and up and up till it got here. So when you see hammer at the bottom of the downtrend, this is a downtrend now. You see it somewhere here. It is a reversal, very downtrend now. You see it somewhere here. It is a reversal, very strong bullish reversal pattern that the price is going to go back to the other side. Then the next one is the shooting star pattern. The next one is the shooting star pattern. The shooting star is like the opposite of this. It is the opposite of the hammer pattern. So look at it here. It is the opposite of the hammer. Let me show you in the picture first before I explain. Shooting star, as you can see. See the shooting star pattern. Basically shows you that the price opened here, right? Then buyers pushed it up, but they could not push it higher than this place. Then sellers entered the market and pushed the price downwards below the opening price. So if you look at the chart now, let me look for the shooting star. So look at the shooting star pattern. See, it opened here, right? Then buyers pushed it up. They pushed it up, then it came back as low as this. They came back and closed it. So it closed below the opening price. That is the shooting star for you. So the psychology behind this candlestick is that buyers tried to move the prices higher, but they could not gather enough momentum when the strong selling pressure stepped into the market, then pushing the price back to the downside below the opening price. So if you see it at the end of an uptrend, it will signify a strong reversal signal when it is seen at market top. But this is not a top. It was not seen at the top, so it did not really have much effect like that. Assuming you saw it at the top, if you see it at the top, somewhere like this, it signifies that the market is going on a downtrend. Then the next one is the Arami or inside bar. The Arami or inside bar. And the Arami or inside bar, it has the bullish and the bearish one. Arami, where is it though? As you can see. So this pattern is considered a continuation or a reversal pattern, depending on where it is found. It can act as a continuation pattern as well as a reversal pattern. So as a continuation pattern, it tells us that the trend in place is going to continue. Then as a reversal pattern, it tells us that the trend is likely to end. So this pattern is comprised of two candlesticks. The first candle is big. It's a bigger candle. We call it the mother candle. This, we call it the mother candle. Then followed by a smaller candle called the baby candle. For this pattern to be valid, the second candle should close within the first or parent candle. It was close similar to it, as you can see. It's close to the bearish candle, to the first one. So this means that the closing price of the smaller candle should be within the body of the big candle, as you can see, it's within the body. So the psychology behind the Arami pattern is that the market is in a state of indecision. In other words, neither buyers or sellers are in control of the market at that moment. So when this pattern is seen during a rally, it gives us a good opportunity to join the trend when it is spotted at the bottom and not at the top of the market structure. It signals us that the reversal might likely come into play at a particular point in time. So it has bullish and bearish. This is the bullish one, and this is the bearish Arami. You see a green and red. Let me show you in the chart. So this is the bearish Arami. As you can see, it's spotted at the top. The bearish was spotted at the top. See, it will close similar to the body of the bullish candle, and it will reverse. As you can see, it's at the top. Take note of where you find it. It was found at the top. So, as you can see, the next 2-3 candles were bearish. The next 2-3 candles were still bearish. It still continued up to this place, as you can see. Then where is the Arami, the bullish one? The bullish Arami. You see the bullish one. See, it was spotted at the bottom. This usually works most of the time also, same as the bullish engulfing. It is similar. As you can see, it closed around the body of the bearish one. See, it was on a downtrend from here. It was on a downtrend. So even this one too is still Arami. You see a bullish Arami. But this was where the change first was at the bottom. As you can see, it went high. So take note of the zones that you find these patterns also, but do not shade the patterns alone. Then the last one, but not the least, is the tweezer's top and tweezer's bottom. Tweezer's top. See, usually have similar size, almost the same size, green and red. This is tweezer's top, is bearish. Then the tweezer's bottom is bullish. Green, red and green, bearish and bullish. Let me show you in the chart before I explain. So this is a tweezer's bottom. See, similar size. Similar size. So the tweezer's top is a bearish reversal pattern. Let me go to the tweezer's top, sorry. As you can see, they are similar. The tweezer's top is a bearish reversal pattern in the sense that when this pattern is seen in a bear trend or a downtrend, it's likely to occur. As you can see, it happened. The next candle was a very, very big bearish candle because it was founded at the top, at the zone, so it's at a major zone. So this pattern is mostly found at the top of an uptrend. As you can see, it was at the top. It's at the top. The formation consists of two candlesticks. The first candle is bullish, and the second is bearish, usually almost the same size. Almost the same size. Then the market psychology behind this pattern is that buyers drove the price up, giving the impression that the market will continue moving upward. But then after that, sellers stepped into the market and they overwhelmed the buyers, which caused a lot of selling pressure coming to the market, which made the price drop and close below the open of the first candle, as you can see. It's close below the open. See the open here. It's close below it. That is why it is a tweezer's top. Then the next candle was very bearish. Then let's look at the tweezer's bottom. As you can see, same thing. Bearish, bullish. The next candle was bullish. See, it was like a downtrend. It followed the downtrend. Then the trend changed. They are very, very similar. Tweezer's bottom and bullish engulfing, they are very, very similar. It's just little difference between them. So the tweezer's bottom is the bullish version of the tweezer's top. This is the bullish version of the tweezer's top. It is usually found at the bottom of the downtrend. This pattern is very strong and will signify the start of an uptrend when it is found at the bottom of the market. This candlestick comprises of two candlesticks. The first one is a very strong bearish candlestick, as you can see. The bearish candle is very strong, same as the bullish, followed by the bullish candlestick too. Sorry. The market psychology behind the formation of this pattern is that bears were in control of the market and were driving prices lower as usual. And then they drove prices lower to the point that they could not push the price further. Then bullish pressure steps in. As you can see, they pushed it down towards as below as this. Then bullish pressure steps in, they pushed it above the opening price or almost at the opening price. It is similar, thereby making the price close above the open price of the bearish candlestick, as you can see, above the bearish candlestick. So it is bullish. So in summary, understanding the market psychology behind the formation of all these patterns will give you an edge in understanding what the market is trying to do, to give you an understanding of what the market is trying to do. So once you can understand or see clearly what the market is trying to do, to give you an opportunity to make the right decisions and how to plan your entry and exit the market. These patterns are not just traded on their own. They are not just traded on their own. As you can see, you don't just trade the patterns on their own. You look at them, you look out for them in zones. So the reason I entered this trade here, I saw this hammer pattern at a very important zone. See, this is a zone. Even though it still came down, but it's still on profit at the moment. As you can see, I set it since yesterday, and it's in profit at the moment. This is because I look at it at zone, a particular zone, then it moved up. At this place, someone can lock profit because this is also a zone. And you can just wait for TP1. That is how it works. So this pattern are not just traded on there. You look at so many factors also, so many other factors before entering a trade. You don't just trade with candlestick patterns alone. You look at other factors too. You need the help of your support and resistance, your trend line, and possibly other technical indicators to confirm and get confluence of the pattern before you trade it. Never trade with just candlestick pattern alone. There are so many indicators that determines how you enter a trade. As you can see, support. This is a support. This is resistance. So you look out for all these things too before you enter a particular trade. So I'll be giving you an assignment via my voice note. I'll give you an assignment via a voice note. So that is the end of this class on candlestick patterns. I believe I have covered everything you need to know on candlestick patterns. Do have a splendid day and night ahead.
I only trade with TENTRADE. You should too. Check the description in this video for more info.
Here, these are some of the exclusive benefits you get from me when you sign up with TENTRADE through my link and get any of the instant live funded accounts or the Express Challenge accounts. Send me a DM for any enquiry. TENTRADE has the fastest withdrawal in the industry and they've been around since 2017, and they have trader friendly rules and they want their traders to succeed. They have the best customer service in the industry too, and they are giving a personal account manager once you sign up. A trial will convince you and you are in safe hands. Don't forget to click the Linktree link in the description for any enquiry.
Follow me for more educative contents like this.